Hi, my name is Mike Ford. I'm with Coast Commercial Credit. I'm the managing director. Been financing car washes for over 30 years. And I'm here today to talk to you about car wash financing. Some of the things that we're going to talk to you today about are seller carry, small business administration loans, conventional loans, USDA business and industry loans. With the COVID pandemic, there are a lot of lenders that have stepped to the side. They've paused lending. And so I want to let you know right now that there are loans available, and the first type of loan available is a seller carry land contract. It's the most flexible type of loan, and the reason why it's the most flexible type of loan is because the seller may own the property or may not own the property, may have a loan on the property, but you're negotiating directly with the seller. So it could be the lowest cost, and you could be the quickest to market. For example, if you had a $3 million purchase, the seller says, okay, you give me $500,000 down and I'll finance $2.5 million. You could be in that business within 30 days, really simple. But there are some cautionary items. And those cautionary items are environmental contamination and legal or title issues. And so if you're doing a seller carry or land contract, you must use professionals. You want to have a lawyer, you want to have a real estate attorney, you want to have a title company. And you also want to use an environmental firm to make sure that the property is not contaminated. So I'll give you an example of a transaction where a customer did not use a title company or a real estate attorney and ended up in trouble. A gentleman came to us. He had been 9.5 years in a 10-year contract, seller carry contract. And he came to us and he said, I want to finance the conversion of my wash. And the conversion of the wash, he was a hand wash, it was a hand tunnel wash, he had a good business, but he wanted to automate. He wanted to turn it into an express exterior. So we approved him for the financing for that facility. Then we went back, and as we were going through the closing process, we were going through title, found out that he had 27 liens on that property. It wasn't from him, it was from the seller. The seller actually was not paying the state of Michigan, and he wasn't paying the payroll taxes. And so if he would have used an attorney and a title company, they would have discovered those issues up front, and he wouldn't have paid 9.5 years. Basically, the state of Michigan owned all of the assets that he was financing. So you don't want to be that person. You want to make sure that you use the real estate attorney, you use a title company to make sure that property is free and clear. And the other reason you want to make sure it's free and clear, for example, if they have a loan on that property, and that seller just stops paying on that loan, then you're going to be in a position where you're going to have a lien that if the seller defaults on that lien, the bank's going to come back and take back that property. So let's move forward to SBA lending. SBA lending is the most common way to finance car washes for new investors. And the most common SBA loan is the SBA 7A. The SBA 7A, the down payment for an SBA 7A is between 10 and 20%, typically around 20%. The term is 25 years. The rates can be fixed or variable. And here's an important thing. You can finance the land, the building, the equipment. Those are, the basic building blocks. But what other things can you finance? Working capital. What's working capital? Working capital is money after you open your doors that you have for basic operational expenses like your insurance, like your marketing. Other things that you can finance in an SBA 7A are inventory. So you want to have an opening inventory. Typically, the opening inventory for an express exterior car wash or even a full service, probably somewhere in the area of $10,000 to $25,000. Working capital is probably anywhere from $50,000 to $100,000. Okay, other things that we look at when we're financing using the SBA 7A loan for financing. Contingency. What is contingency? Well, contingency is funds that are set aside. Let's say that your construction costs are $1.5 million, just the construction cost alone, $1.5 million. We typically put in a 10% contingency in your loan for cost overruns. For example, if the city comes in and says, okay, You need to move that door 5 feet to the right or 5 feet to the left because it's no longer ADA compliant, even though they approved it. You have to pay the contractor to move it. And if you don't have a contingency in your loan, then you're going to pay 100% of those funds out of pocket. So typically, again, 10% of the construction cost. At a $1.5 million construction cost, you would have $150,000 in contingency for change orders. Now, you want to make sure that that contingency is in your loan proceeds, but not in the construction contract. You want to control the money, not the contractor, because if the contractor controls it, it's gone. Other things that you want to have included in your loan that can be included in an SBA 7A loan are soft costs, like permits, architecture, engineering, impact fees. All of those things make a complete project, and SBA 7A lending covers the complete project. The typical rates on an SBA 7A right now are between 5 and 6%. Let's talk about the 504, the SBA 504 program. The SBA 504 program is a very unique program. It is a program that you can finance for 20 to 25 years, and it requires 20% down for startups. So if the SBA 504 program is actually a 10% down program, but specifically for car washes, the SBA requires, if you are a new operator, you add to that 10%, 5% for being a startup. And then because the car wash is a special purpose property, special purpose properties are properties that have limited use. So if you have a car wash tunnel, can only be used for a car wash, maybe a drive-through beverage store, but not the same as a square box building that can have a shoe store or a bakery or an office. And so car washes are specifically identified as special purpose properties. And so that's why you have to put in 20%. In addition, SBA 504s exclude working capital and inventory. So you have to put in 20% plus working capital and inventory. So you may be putting in 20% plus $100,000, $120,000. You have to prepare for that. Now, the SBA 504 is two loans. There's actually, so you put in 20%. The SBA, through a certified development company, underwrites the other, they guarantee the portion, the next 30%. And then you have a conventional portion of 50%. So 20% is yours, 30% is a certified development company, and 50% is a conventional loan. Okay, the advantage of the SBA 504 is that it does have a very low rate. The rate on the SBA portion is under 3%. Right now, this month, it is 2.27%, which is very attractive, way below market rates. The conventional portion generally ranges from mid-4s to 5.5%. So you have a blended rate of around 4%. The SBA 504 has a lower rate, but it's also difficult. And the reason why it's difficult is because it does not include a construction loan. So you have to have a separate construction loan. Then you have to go through the CDC, the Certified Development Company underwriting. You have to be underwritten by a conventional lender. And then the SBA reviews the entire package. So you can go through 4 underwritings in doing an SBA 504. So there's an opportunity cost when doing an SBA 504. The rate is better, but the opportunity cost is time. So if, for example, if you're projecting $100,000 a month in revenue, or $1.2 million a year, if it takes you an extra 30, 60, 90 days to go through an SBA process, SBA 504 process, you're looking at losing $200,000, $300,000 in revenue. So it's very significant. You have to make a conscious decision as to what you want to do. And there's trade-offs with everything you do. And really, we'll talk about the next thing, which is conventional lending. Conventional lending, there's a trade-off to that too. In conventional lending, what is a conventional loan? First of all, conventional loans are loans that are underwritten by financial institutions that do not carry an SBA guarantee. Okay, so you have a loan that is only backed by the assets financed. the typical loan to value on a conventional loan is 50 to 70%. So compared to the 90% in an SBA 7A or 80% in an SBA 504, you might be looking at anywhere from 50 to 70%. Right now, we're doing 65%. And that's not including some of the soft costs, like the working capital and inventory. So it's very important to understand that. Rates and terms can vary under the conventional loan program. It's up to negotiation. Typically, the rates on a conventional loan range from anywhere from 5 to 5.5%, maybe even in the high 4s. Terms can vary. They can be as little as 10 years. So timing or time involved in a repayment is very important because it affects the payment. So if you're paying back, $4 million over 10 years, the payment is going to be astronomical. Versus the next type of financing that I'm going to talk about, which is USDA. The United States Department of Agriculture has a business and industry program, okay? And the financing term for the USDA program is 30 years. So compared to, say, a 10-year term in a conventional loan, a USDA loan is 30 years. So your payment is really low, and that's an advantage. The USDA, though, is only available for rural sites. So if the population is under 50,000, you may qualify for a USDA loan. It's an 80% financing product, and it's very similar to an SBA 7A. The pricing is very similar. Typically, you're looking at rates between 5 and 6% under the USDA. All right, well, if you have any questions regarding financing for new investors or financing in general, please feel free to contact me. My name again is Michael Ford. I'm with the Managing Director of Coast Commercial Credit. I can be reached at 800-400-0365 or mikef@coastcc.com. Thank you very much.